Welcome to PSG Asset Management with me, Joanne Baynham, independent moderator. Today I'm joined by Justin Floor and we're going to discuss everything equity. So I'm really excited about our conversation. So I guess my question is, why do you think your returns are sustainable? What gives you an edge that you can keep repeating good performance?
Yeah, that's a great question, because I think a really smart question would, or a smart strategy might be you go and disinvest from all the guys who win awards and go and hunt for the guys that are at the bottom of the ranking pile and invest in them. So we think that is actually not a bad thing to do. It's actually what we do on stocks broadly, is we try and go to the areas that are out of favor, that have maybe had a tough time, but have a much better time ahead of them. But what's really interesting right now, and it's a bit of an interesting story, is we think we're in this at least a decade that's going to be very, very different from the last decade. And we've only seen basically 2 years of it. And I think COVID was really that flashpoint that cleaned out a lot of the low interest rate, free money stuff that had kind of infiltrated into the whole market. And that's really set up some really interesting things. And there's a couple of interesting themes that we're looking at. I mean, the one is there's been this massive underinvestment in stuff that people need. So basically basic infrastructure, commodities, mining, energy. It's a whole host of reasons. One of the most important reasons is just they've been such bad investments for the last decade when everyone was in tech and the exciting stuff. And nobody's invested. Now there's ESG concerns, politics, and what it's meant is as the world goes on, we always need this stuff. We think that's going to be an enduring theme. So we think, yeah, we've had 2 years. It's not going to go away overnight. So that's a theme we're definitely trying to exploit, and we see a perhaps even multi-decade opportunity there.
So there's this theme, and I think you guys refer to it as regime change, which is very catchy. But then there's this problem where what we're currently facing in the world is a potential US recession. For the very same reasons that cleared out COVID, lack of zero interest rates anymore, the world is changing. A recession doesn't tend to be good for those stocks that you're mentioning, the mining shares, the energy shares. And I think if I'm right, energy shares are down 15% year to date. How do you marry within your process this kind of, you go to where people are not and you're buying shares relatively early, but also trying to give clients a decent journey along the way? Even if you're right long term, you might be horribly wrong short term. So maybe just give me a better feel for how you smooth that process out.
It's a really good question. Yeah. So I mean, one of the, I think, foundations of how we've set ourselves up is we tend to construct portfolios that look quite different, and it's in areas that people aren't in yet. And as a result, sometimes you can be a bit early, and you can have very different performance from everybody else. Most of the time, that's a very good thing, but every now and then it can be challenging. So what we need to do is really, almost when we construct the portfolios, is have a system and a philosophy that helps us navigate those times in between. It's almost like these bridge times before our views and visions get realized. So there's a few things that we've been doing there, and one is I think we've tried to become a lot more macro aware, and this is an evolutionary thing. And for the last decade, you didn't really have to be. You just had to appreciate that low interest rates were there and here to stay, and then go and find whatever growth was available, and it didn't really matter what you paid. And that was if you did that, you were fantastic.
I must tell you, a lot of people tell me I'm a dinosaur because I still think in, economics works, and they go, it didn't work for the last 10 years. And it was all about zero interest rates. You just bought anything and it went up.
100%.
So I'm so glad. I love hearing what you're talking about, that the world's changing. Sorry, I interrupted you.
No, that's exactly right. And the other one is that the price didn't matter for a long time, and now we think it will, because as interest rates go up, all of a sudden the price of money has gone up, and there's going to be much more differentiation and dispersion about valuation. And we're starting to see that now. So you're getting rewarded for buying cheaper assets, where for a long time it didn't really matter. So that's the one thing, is being more macro aware, because we're in this environment where we think there's a material shift. And I've spoken about the supply constrained underinvestment. We also think we're going to be in this world of higher interest rates, and they're going to be volatile. Broadly, the way we would describe it is we think we're going to be in a more volatile, but probably average at a higher level in terms of inflation. Now, you're going to have years and periods where it's going to come down. Everyone's going to be excited because we're going back to the prior regime. But we would just say that that's just part of the natural ebb and flow. So what we need to do is have a macro awareness that helps us to navigate that. And then we couple that with what we're really trying to do is almost like a deep humility that, especially in shorter periods of time, the markets can think about things very differently to what your long-term work suggests is the correct one. And so one elegant way of doing that is constructing portfolios in ways that have very different drivers and have different offsets. So we've got, and I can give you a few examples, but a couple of interesting areas of the portfolio that are very, very different from some of the other areas. And that's intentional. And it's actually as part of our idea generation process. We'll actively go out, try to be creative about it and generate good ideas that fit our framework and our philosophy, but that are going to fire when the rest of our portfolio is maybe having a bit of a tougher time. You put those together, we think you can kind of smooth the journey a little bit. So it's not something that, we can never take that volatility completely away.
We're doing derivative exposures now. Maybe you're buying put or call options, or you're selling call options. I don't know how you do it. I'm not clever enough to understand this stuff. But just give me some feel how you're doing things slightly different, macro way. I love that.
So that's a very good case study. So what we're doing here is we think we've got a set of investments in our client portfolios that are very, very attractive bottom up. But they could, because they look very different from everybody else, they need to be constructed in a way that'll give our clients an appropriate ride. And we think derivatives are very simple. We don't make it complicated, but we will do things like acknowledge that there's probably a lot of market risk at the moment. And there's, for example, we acknowledge there's a lot of macro risks. You mentioned the US recession. We know valuations are very high in a lot of global equities, particularly at the moment. So an elegant way of doing that is when the market's complacent, is you basically just buy insurance.
Okay.
And you're willing to give away a little bit of return, and we've got strict budgets in place in terms of how much we're willing to pay, and it's finite. I mean, the way insurance works is you know exactly what you're going to pay. The worst case scenario is known up front. It's very different from an equity, and but the upside is potentially very large in that instrument, and it'll happen at exactly the time that you need it most. It's a process issue and a behavioral issue. And we try and tackle it in both ways. So the one is very strict discipline from a process side. So we've got very strict process flags and signals that'll tell us, okay, this has worked. Basically, ultimately, what we're trying to do is these instruments are not as attractive as they were. They've gone up in value. Mm-hmm. It's exactly like buying a stock or a bond or anything like that. So we would be looking to sell. And we call it like selling volatility, but effectively selling these derivatives, basically closing them down and redeeming the cash when everybody else wants them. So, and that's typically in times of deep market stress.
Yes.
And then what happens is then our process kicks in hard because we've got a behavioral temperament to get really excited when prices are low.
When markets are falling, buy. And when markets are rising, sell. How do you get your heads around this fear and greed? Because we're human beings.
Yeah. So if only it was that easy, because it does sound easy. You just do that and then off you go.
Well, it's never easy. That's the point.
So there's a couple of things. One is it's very important that you have a unifying culture in the team, and that goes right from the senior members right down to your brand new grads and new joiners that are joining. And it's very important to inculcate that thinking of rationality, of understanding that price matters, and then understanding that when market stress happens, that's often a gift. Not always, so you have to have done your work, and you have to know, what the downside risks are and what we call the value trap risks are, and often they're balance sheet related. So you have to have done that work, but provided you've done that work, that's when alpha is created. It's created when everybody else becomes irrational about pricing. So that has to be almost a cultural attribute. It has to be prized in the team. So it's demonstrated and it's lived every day. But also when we're recruiting people and trying to attract people into our team, we're selecting for people who are kind of wired to think like that. March 2020, just to give you an example, exactly 3 years ago, when we had the COVID crash, you could have imagined coming into the average asset manager office. We're going into lockdown, we're going into the Great Depression, asset prices are absolutely cratering. You come into kind of PSG's investment team meeting, you'd probably be surprised at how excited everyone is because we've never had the opportunity to buy these companies at such ridiculous prices before, and now we can go wild. So you need that you definitely need that, and it's intangible, but it's so powerful when it works.
Working under PSG Asset Management allows you that perhaps more flexibility if you're wrong. for want of a better word. To be early
Yeah.
is often being wrong. Do you think that the culture of the company allows that?
Yeah, it's a really good question, because as investors, we could be as excited as we want and have the long-term perspective and the patience to sit it out. But if we're making it very difficult for our clients and our other stakeholders, including our shareholders, then that's going to be a very challenging, right? So it's very important to manage that. In our case, we think there's a real value add for investors that are willing to be different from the pack, but you can generate real return. And especially, this is a side point, but I think it's very relevant here. We think we're going into a decade where beta, so market returns, are probably going to be very low. So we think if you put your money in an index fund, it might not be as great as it was in the last 10 years. And so what you're going to need is you're really going to need alpha. And that's where we come in. But in order to get alpha, you have to do things a certain way. So it's very important that you have the client alignment. So that's point number one. And then having a supportive shareholder that also understands you and gets you and is not going to pull the rug underneath you at the time of maximum opportunity, which is how we would describe March 2020. Not maximum, that's point of maximum opportunity. If they get that.
Or maximum pessimism, I guess, another way of putting it.
Exactly. Then that helps a lot. But ultimately, the third very important stakeholder is the team. You as an investment team, you are put under immense pressure. You can just imagine what it's like, especially if you've come into that environment, which is what happened to us. We were actually quite early being positioned in a lot of these areas that have been very successful in the last couple of years. But those areas probably got the worst time during COVID. And so we were positioned for that. We were ultimately, I think, right. But COVID came in between. And that's a very, very tough thing psychologically, emotionally to deal with. So again, you need that experience, you need that team culture, that ability to just be rational, get those emotions down, get back into process and let the process kick in for you.
Gold equities.
Yeah.
You talked about put insurance just now. Insurance is relatively cheap. Gold equities doesn't strike me as something that PSG would naturally want to buy.
Yeah.
I'd imagine the margin, motive safety management is probably not something that you get terribly excited about around gold.
Yeah.
Right now, you're buying it. Why?
Yeah, it's really
my last question.
It's a really insightful point. So you're 100% right. In and of itself, intrinsically, we like to be bottom-up investors. We like buying cash flow streams of businesses that we understand and that we can put through our process. Now, gold has some very interesting characteristics, but those aren't really those. So you ask the question, why you have this is kind of completely almost out of your process.
Contrary to how you guys think.
And indeed, historically, if you looked at us, we wouldn't have had material or any investment. It's really been a feature of the last couple of years. And the key thing for us is we're looking, again, as part of that being macro aware and portfolio construction and bringing them together, because what we think is very important right now is to realize that money has changed. In the last decade, it was about financial assets. And you've had such devaluation, and whether it's printing of money and fiscal stimulus in the usual types of money, that alternatives, so real assets, commodities, but also gold. I think there's 5,000 years of history there. So we see gold really as a currency more than a commodity. There's no supply side thesis around gold.
Well, the Chinese are buying an awful lot of it, and so are the Russians.
Well, this is
the world is changing.
This is the other thing is, with Russia being kicked out of, they basically had their central bank assets confiscated. And I think what's happening is that people are realizing to have your central bank or country reserves in US treasuries and Europe, Deutsche Bunds and that type of thing is risky. But geopolitically, but also from an interest rate perspective, as we've seen. So I think what happens is alternatives start becoming more interesting, and you're seeing, gold is becoming. Gold is a tiny fraction if you look at central bank assets. If that thing doubled, what would the price of gold be? I don't know, but it's quite interesting. And I think ultimately what you do is you just see how does it respond when other things in your portfolio are struggling, and we're in this environment of Credit Suisse disappearing overnight. Gold becomes quite interesting then.
Yeah, it does. But I just want to make sure that people listening to this call, though, it's not a huge part of your portfolio. Because I don't want anyone to think, oh my gosh, PSG have lost their minds. They're buying gold shares.
No.
What are they doing? This is a small component, but it's quite different to where it's been in the past.
Absolutely.
So it's right. Just make sure anyone listening to this understands that.
Yes, it's right-sized. But also the other thing we do is, we think about risk quite creatively here. So our exposure in like the more risky kind of assets, which is your deep level miners, is very, very low. We've got a small position in Anglo Gold.
Okay.
But the bulk of our position is actually in a company called Wheaton Precious Metals, which is I could talk about this company for hours, but really what they do is think about them as a toll road. What they do is they buy streams or royalties of other mines. So they take no mining risk, no operational risk. Their cash margins are 90%. But you've got a very smart management team that is just layering these streams.
What's this company called?
Wheaton Precious Metals.
Okay,
So
I'll have to Google that after this call.
Well, if you look on our top 10, it's in most of the funds top 10, and I think it's for us. This company has no debt, needs no debt. It's basically a conduit.
A very clever way to play gold.
For gold. So we call it the gold toll road. And you get much more leverage than you would just by holding the GLD ETF, but you're not taking anywhere. You're probably taking a fraction of the risk that you would if you bought a Harmony or anything like that.
Justin, I could feel like I could talk to you for hours, but unfortunately we've run out of time.
Great.
Thank you so much for your time today.
Thanks, Joanne. That was fun.